An important question that many people don't have the answer to is how much money should I not have in the stock market? I'm James Studinger, financial planner and author of Wealth is a Choice. I believe that wealth is a choice and that people get wealthier by simply buying things that make them more money. I hope everyone understands that the stock market is volatile, but it's also the place where most of us will make our best long-term returns. So we need equity exposure, but in the right amounts. After the financial crisis in 2008, I came up with a method to determine how much money somebody should have in stocks or bonds as part of their portfolio. This answers a common question that people ask me, which is, now that I'm getting closer to retirement, should I have a 50-50 portfolio? 50-50 refers to having half your money in stocks and half your money in bonds. Rather than develop a generic allocation based on somebody's age, which has nothing to do really with how much money somebody should have in stocks and bonds, I calculate a decade's worth of projected distributions to determine the mix. Let's use some really big simple math with fun big numbers. If you're retired and have $1 million and project that you need $35,000 per year to supplement your fixed income, then you need to shelter $350,000 from the stock market. In other words, 35% of the investments are not in stocks for a 65-35 portfolio. Life is a little bit more complicated than that simple math, and you need to factor in inflation and expected rates of returns. But that's the basic premise. What if you don't know your burn rate distribution number? The unknown causes people to do silly things. Most people spend lots of time worrying about things that shouldn't scare them. This leads to stress, which isn't good for your health, state of mind, or decision making. Some people go to extreme with protection strategies that are incredibly expensive in the long run and could be devastating to their financial security. This can include an overuse of annuities and fixed assets causing higher actual and opportunity costs. Some people are on the other end of the spectrum. They carry lots of volatile equities. And when we go through another period of prolonged declines, they'll need to sell those assets at a deep discount to pay the bills. If they are retired, they will likely never make those losses back. Instead, they should focus on good information and productive strategies. Don't wait until you're retired to do the burn rate math. Waiting could have devastating consequences. Also, do the math each year. I like to do it in January with a fresh set of analysis and data. 10 years of distribution is what I shoot for, but in some situations that might be out of reach. Do the math and then see what level of coverage you're comfortable with. Managing your money should be a fun and liberating experience. While not as robust as our in-house software, we do have resources for free on our website for those that like to get into the numbers on their own.
Ta-da!